Very recently, RBI ordered 5 banks to issue a zero coupon bond. What are zero coupon bonds and what are its implications for the investors and issuers? How has the accounting and presentation for the zero coupon bond changed under IFRS as compared to IGAAP? Zero coupon bonds, also known as the discount bond or deep discount bond, is a bond issued at a price lower than its face value, with the face value repaid at the time of maturity. It does not make periodic interest payments or have a coupon rate, hence the term zero coupon. When the bond reaches maturity, its investor receives its par or face value. The accounting and presentation of zero coupon bonds has been substantially changed in IFRS and Ind AS as compared to the erstwhile IGAAP. When bonds are issued at less than their nominal value, they are said to be issued at discount. For example, bond of ₹100 each is issued at ₹80 per bond for a term of 4 years. Under IGAAP, these bonds will be accounted as follows. Bank account debit ₹80, unamortized discount on issue of bank's account debit ₹20 to bonds account ₹100. Company gets the benefit of funds by issuing bonds over a number of years. Hence, the discount is to be amortized over the term of the bond. In the given case, since the term is 4 years, every year ₹5 will be written off from the unamortized discount on issue of bonds account. This will be presented as below. Interest expense account debit ₹5 to unamortized discount on issue of bonds account credit ₹5. What has changed under IFRS and Ind AS? As per IFRS and Ind AS, the amortized cost of a financial asset or a financial liability is the amount at which the financial asset or the liability is measured at initial recognition minus principal repayments plus or minus the cumulative amortization using the effective interest method of any difference between the initial amount and the maturity amount. What is effective interest rate? It is nothing but the internal rate of return, that is the IRR. Hence, to account the same zero coupon bond under IFRS, we will first calculate the internal rate of return and amortize the discount over the period using the derivative IRR as follows. The IRR for our example comes at 5.74%. As you can see on the table, on day 0, the cash flow is 80, discount 20, resulting in a gross of 100, and based on the 5.74% IRR, the year 1 discount will come to 4.59. That is 80 into 5.74%. Similarly, the same discount will be calculated for year 2, year 3 and year 4 at 4.86, 5.13 and 5.43 respectively, resulting in an outstanding of ₹100 at the end of year 4. This is how the accounting will take place under IFRS. The accounting entries for this transaction would be bank account debit ₹80 to bond liability ₹80, being liability initially recognized and measured as part of IAS 39. The accounting entry for the interest expense will be interest expense debit ₹4.59 to bond liability at ₹4.59, being interest accrued at IRR on the liability for period 1 and so on and so forth. So, the two major differences in IGAAP and IFRS for the accounting and presentation of zero coupon bonds are: under IGAAP, liability is recorded at gross value, and under IFRS, liability is recorded at present value. Under IGAAP, discount is amortized as prepaid expense over the term of bond on SLM basis. And under IFRS, discount is factored in while arriving at the effective interest rate of the instrument and amortized over the term. Are you intrigued on the practical aspects of IFRS? Do you want to understand how Ind AS works using real-world case studies? To understand the business implications of IFRS and Ind AS in such a holistic manner with the help of real-world case studies, log into our website in the description below. And for more such interesting content, subscribe to this channel now.